Now we will see a finance lease from a lessor's perspective. For a finance lease, we actually call it sales type lease when we do lessor's accounting. For a finance lease, what we call from a lease's perspective, actually this type of lease is kind of a financing option for the leasee, because the leasee, instead of purchasing the asset and paying the huge amount for the purchase price of the asset, the leasee is actually using that asset and gradually paying the liabilities, and they are also paying interest expense. So that lease is very much considered as a finance lease or financing option for leasing. On the other hand, for this type of lease, lessor actually transfer the control of the asset to leasee, no matter the legal title is transferred or not, and that's why from lessor's perspective, we call it's a sales type lease. Now, first step, for every lease we actually do a lease classification test, and this lease classification test is pretty much same for the lessor and the leasee. So no matter if one of these tests is met, then both parties will consider as a finance lease, and if none of the tests are met, then both parties will consider as an operating lease. Now, for lessor's perspective, a sales type lease is similar to sale of an asset. So what the lessor will do, just like the leasee who records a lease liability, lessor will record lease receivables, and lessor will also record the sale of an asset. So when lessor is recording the sale of an asset, lessor will also record cost of goods sold and eliminate that leased asset. Now there is also a difference when we calculate lease liabilities, lease payables versus lease receivables. So from lease's perspective, if you remember, when they calculated the lease liabilities, they actually included the present value of all rental payments or the monthly or yearly installments. On the other hand, when the lessor will calculate lease receivables, lessor will include both the present value of those installments plus the present value of the residual values. That means whatever they will get at the end of the lease term, and they will include both guaranteed and unguaranteed residual value. Now, we will see the same example with little more information to explain the sales type lease from a lessor's perspective. So here again the same example, coffee and beans equipment is the lessor and Starbucks is the leasee. Lease is signed on January 1st, 2025. Lease term, installment, everything, fair value at the commencement lease, all are the same, estimated life, all are the same, residual value is all the same. So just you have little more information about the leased asset, the cost of that asset or that the roster that is being leased is $85,000. Remember, for sales type lease, lessor will record a sale, and that's why they need to record the cost of goods sold, or they need to know the cost of that asset. Residual value is the same, and it's also probable that the actual residual value will be higher than the guaranteed value. That means they will receive some, of course, this guaranteed residual value plus some unguaranteed parts, and the equipment will be reverts to coffee and beans. But remember, the life is 5 years, and Starbucks will also use it for 5 years. Now here a little more information. It is important, collectibility of payments by coffee and beans is probable. You learn the revenue recognition, so it's one of the conditions that you make sure that you will be able to collect all those lease payments from your leasee. And then we will use the same rate of return. Now let's see how these journal entries and financial statement because of these sales type lease will look like on lessor's book. So now when the lessor will actually determines what will be the lease installment, so the lessor will consider the total fair value of these lease assets, and then the lessor subtracts the present value of the residual amount that they will get at the end of the lease term. And we already know how to use the present value factor table, and for future value, this $5,000 actually is a future value or the residual value at the end of 5 years. So if we use the present value factor, you will get the present value is 4,109, and then if you subtract that, because these the lessor will get from that asset, whatever the asset condition is, this is the guaranteed residual value. So that means through the lease payments, the lessor needs to recover or get 95,890.35. And then what lessor did, lessor actually calculated what would be the installment or annuity due payment using this present value amount and using this 4% rate and 5 years, and they found that each lease installment should be 20,711.11 to recover all this amount over the 5-year period. So this amount we already know before, and most of the problems actually will give you this annual installment payment. Now here, of course, the lease classification test, you remember that the present value of these payments is equal to or greater than 90% of the current fair value of the assets, and the lease term is also 75% or more, and in this case it's actually equal to the economic life of the assets. So two criteria, two tests are met, so we can call it a finance lease or sales type lease. Now, how the lessor will calculate the lease receivable. So again, here you have slight difference between how a lessee calculated the lease liabilities. Lessee only included the rental payments because that's what the lessee is supposed to pay. At the end of the lease term, the lessee does not need to pay anything. If they would also include it. Now the residual value will receive it, the lessor will receive it because the asset will be returned to the lessor. So when the lessor is calculating the lease receivables, they will calculate the present value of those all rental payment. The other way you can see this, how it is calculated, and then the present value of the guaranteed residual value. So here, the lessor will record the entire amount, $100 million, as lease receivable. So the lessor will record this as a lease receivable and sales revenue as if they are selling that roster, and the lessor will also record cost of goods sold. So the previous slide told you the information about the cost of that roster that they are selling. It's $85,000, and they will also eliminate that asset or as eliminating the inventory. So you can do two separate entries, or you could combine both in one entry. This is the lessor's first journal entry when the lease is created or the contract is signed on January 1st, 2025. And then if you see the amortization schedule, it's done pretty much the same way, but just the only difference, if you remember previously, the lease liability was different because that time we only considered the present value of the rental payment. We didn't consider the residual value. So in our previous or leases amortization schedule, the lease liability was $95,890. On the other hand, lessor included both the present value of the rental payment and the present value of the residual value. So this $100,000 is the lease receivables on lessor's amortization schedule, and the rest is the same. On the very first day, the lessor received the first payment, which is $20,711.11, and then that will reduce the lessor's lease receivable. So if you subtract this $20,711 from $100,000, you will receive this $79,288.89. That's the lease receivable at the beginning. And then 2025 passed, 1 year just passed. The lessor will also calculate the interest rate using the same rate. So this, if you take 4% interest on that amount, 4% on 79,288.89, you will get the interest is 3,171.56. Now, here Right after 1 year, lessor will receive the second installment. Every installment is fixed, same amount every year. So now the lessor will consider out of this 20,711.11 installment, this 3,171 as interest revenues, and after subtracting these interest receivables or revenues, they will initially call it and interest receivable, and then actually they will record it as interest revenue. So after taking that interest part out, this rest of the amount will be considered as a reduction of the lease receivable. So again, if you subtract that 17,539.595 from 79,000 to 88.89, you will get this amount 61,749.34. And all these steps are also written here, and this is how the lease amortization schedule will be prepared. Now, one difference you will see at the end. This is the $5,000. After the 5 years of lease, the amount still is there. Now, how the lessor will get it? The lessor will get this amount from this residual value, or the guaranteed residual value part of that asset, because ultimately the lessor will receive the asset at the end of the lease term. So this $5,000 they will receive right after the lease term finished, and they will receive it from that coffee roaster. Now we will see here few other journal entries. So here, this is the first lease payment the lessor is receiving. Remember, every year the fixed rental payment is the same, or installment. So on January 1st, 2025, cash debit 20,711.11. Lease receivable will also be reduced. Now you also know that this interest revenue they are earning, so they will record it interest revenue, and this is also included into lease receivables, because they are pretty much giving a loan to leasee financing, and they are getting that interest too, which is a revenue to them. Now, how they will disclose those on the financial statement? So on their balance sheet, they will of course show the lease receivables on the asset side. Now, at the end of the year, if you go back to the previous slide, you will see here at the end of the year, this is their total lease receivables, but immediately the next day, they will receive 20,711. So this is actually current receivables. And after subtracting that, the amount will be their long-term receivables. So you will split it, long-term or non-current portion. So the immediately payment that they will get it on January 1st, 2025 will be shown as current asset part, and the other remaining lease receivables part will be under the non-current part. On the income statement, first here they are selling this roster, so they will record sales revenue. Although they are not collecting this 100,000, immediately they will be getting it through lease receivables, and they subtracted cost of goods sold. They also recorded that, and they will also record first year's interest revenue. This is the same, just I took a part of that amortization schedule to show the second year's payment and interest revenue. Same, January 1st, this is 2026, they will receive cash. They will receive cash debit 20,711.1, and lease receivables is also reducing, and they will again calculate this amount 4% interest, and they will credit it as interest receivable, and this is also shown as part of the lease receivables. And now here they will do it for all those years, and at the end of the year you will see only they are paying interest on this remaining part, and then they will have this amount, last $5,000, they are not getting it through the leasee. Right, but still it's the amount there. How they will get it? They will get the inventory or the roster, and they will sell it. So they are receiving this inventory residual value 5,000, and they will eliminate the rest of the lease receivables. Now here you will see there is a comprehensive problem which is posted separately on Blackboard. So this problem is similar problem but another example of both parties, the leasee and the lessor, based on the same information. You will go over the problem and you will see how the leasee will record which is their finance lease and how the lessor will record which they will call sales type lease.